Rahul Jain is co-head of Asia Financials and head of India Equity Research at Goldman Sachs. He's with us now to take some questions. Rahul, great to have you with us here. Thank you for your time. So the market seems to be bouncing a little bit, but the one sector, prominent sector, which is underperforming I'm talking about very, very recent markets, about from the lows last 3 days, is financials. And this despite the fact that the RBI has come in again with maybe, according to some, a larger than expected boost to liquidity, replacing durable liquidity in that sense in the market. So what's the top bother in that sense, Rahul? A sector which is widely acknowledged as cheap and has not performed for a number of years, reasonably valued in that sense. Go
on. Thanks, Prashant, and good to be back on your show. Before I take a deep dive into your question, let me just paint the overall picture the way we see it. Last year, we called out that the Goldilocks period was over for the financial sector in India. And this year, we called out that there could be a muddle-through scenario for the sector because the earnings still continue to face the headwinds emanating from all the three factors that we are possibly seeing out there, which is asset quality. You all would be seeing what's happening in microfinance space due to Karnataka ordinance. The asset quality in unsecured is going through its journey. We've seen the credit growth drop significantly from the highs of mid-teens to high teens. And of course, the rate cuts, which will also have its bearing on the margins initially, and then gradually we see how the deposit rates shape up. So clearly the earnings headwind still remains for the sector, and we are yet to see the bottoming of that to happen. We feel that the bottoming out of the earnings cut would most likely happen by June or September quarter. But what we are positive about is the regulators have started to support the sector. You talked about easing of liquidity. We have seen in the last couple of weeks, the regulators come out and ease certain measures such as rollback of risk weights on NBFCs or microfinance lending, etc., which is quite positive for the sector and will ease the regulatory risk premium. But clearly what the market is looking for at this point of time is the earnings cuts, when do they bottom out, what happens to the margins in the near term. But if you see last few months or so, banking sector on a relative basis has held up well, whilst the other sectors were seeing the beating. So we feel that as the confidence returns back on the fundamentals, I think the sector should start bottoming out, but the headwind still remains.
Okay, so maybe you're saying tactically people are looking at financials more favorably, but you're still concerned about some of these issues. I just want to focus on, Rahul, this asset quality piece that you touched upon. If you could expand on that. Where is it that you're still seeing stress? I mean, there was a lot of debate around this, that maybe the worst of the MFI stress will be over by, say, Q1. What are your projections telling you in terms of timelines? And also, the RBI has actually withdrawn some of those macroprudential norms, right? The higher risk weights on loans that are going in for NBFCs or MFIs. So that's already been rolled back. So I don't know. I mean, clearly the RBI felt that it was the right time. There was no need to be as tight anymore. But you still sound a bit concerned. So just elaborate on this.
Sure. Thanks, Urvi. So look, on the asset quality front, we started about 2 years back with our concerns on the unsecured lending. We've seen the last 6 to 12 months that reflects in the numbers for the financial entities. And then we saw how the macro slowed down. We all are witnessing what's happening to the GDP growth slowed down in between. The collection on the GST front were tepid. We also noted that the truck rentals or the freight movement also took a bit of a knock. That started reflecting in the higher delinquencies in some of the commercial retail assets, such as commercial vehicles or MSME loans, etc. So when you look at the bottoms up, I think we still have some way to go before the credit costs peak. We feel that it will likely to peak by September quarter. So still 2 more quarters to go for. But mind you that typically the second half in the financial year always tends to be stronger. But this year it has been tad weaker, and we'll be getting into the first half, which generally is weaker. And there is a IMD projection out there which talks about the heat wave, etc. So I think that concerns the investors that when do we get the confidence on the earnings growth, and particularly if asset quality still remains a concern, then the re-rating takes time. But you rightly alluded to the point that the regulators have been doing to support the sector. I think that's been a big improvement in the last month or month and a half since the new governor has assumed. We are seeing that the regulated risk premia, which had gone up in the sector in the last 2-3 years due to tightening measures, should start to ease off. And these are some of the initial measures that the RBI has taken to support the sector. It will take time to show up in the real numbers, in the real economy numbers, or in the credit growth numbers. So we'll wait to see how that plays out.
Okay. Hi, Rahul. Good morning and good to see you in. Rahul, a couple of questions. I recall you calling out there's more pain in MFI, but do you think it's likely to peak out in the coming quarters? And also, I think you had preference for the housing finance companies, because that's far more secure. Does that preference hold?
Thanks, Nigel. So look, I mean, microfinance, from where it is sitting, naturally, it should likely to improve in the subsequent quarters. But still, the profitability that used to be generated in this space will take time. Like I was earlier saying, second half is typically stronger, but this year it has been weaker, and we will be getting into a period which generally, has see a slower progress into the year. So we'll see. So it's going to take time. It's going to be more of a second half story into the next financial year than the immediate next few quarters. But yeah, I mean, on a relative basis, we've been very, very selective. We clearly like the stocks, where the asset quality is under control and the earnings predictability is very high. So whether it's housing or whether it's commercial retail assets, wherever the ROAs and the asset quality is under control and valuations are not demanding, clearly are the names which our investors are preferring at this point of time.
Interesting that you're saying that, Rahul, but I'm looking at the list of buy calls, and let's pull up the stocks as well for our viewers' reference. Chola Finance, there's SBI Card, there's Shriram Finance, then there is L&T Finance, AUSFB, Aavas, and the large banks include Kotak and HDFC Bank. So I just wanted to come exactly to that, Rahul, to understand the thought process behind the stock selection sort of criteria. And you said that asset quality needs to be stable. That's the number one thing that you're looking at. And then, of course, you're looking at overall valuations. So in the mix, I know you can't talk individual stocks, but I mean, SBI Card is the one I'm referring to. Let's not talk about the stock or levels. But in general, clearly, you're also pivoting towards some of the unsecured, lending setups, though you are cautious. So how does that tie in together? Is that a valuation thing?
Good question, Surabhi. Thank you so much. So without getting into the specifics, I think financials is all about catching the cycles, right? So our view is very simple, that at some stage, unsecured will likely to peak. And, we're already seeing from the bureau data, the credit card delinquencies have started to moderate. And particularly the book that has been written in the last year and a half is showing a much better trends. So as the balances builds up there, you will see an improving performance, coming out of this particular segment of unsecured. And we are calling out that, by June to September quarter, you will see the asset quality peaking for the whole sector. Now, basis this and what profitability each of these segments will generate and where, does the, valuations lie is the call that one needs to take. So like I said, we prefer the names where you got some incremental comfort coming in on asset quality, profitability remaining, quite decent, and the valuations, have been derated over the last, few months or few quarters are the names that we are preferring. But at an overarching level for our investors, we, broadly categorize these into three buckets. First bucket belongs to the liquidity. As the liquidity gets better, some of these names will tend to benefit. The second is the interest rate sensitive. So the names where the impact of interest cut would be lower on the margins would also likely to benefit. And third is clearly, in terms of commercial retail assets versus the unsecured, where do you put your money? So I think unsecured is still going through the journey, will take at least a quarter or two more, and then you need to pick your bets. We clearly feel that credit card is early in the journey. You will see that first bottoming out because it is the first segment to go down when the cycles turn, and will be the first segment to come out when the cycles will start to improve.
All right, Rahul, we'll leave it there. Thank you very much for joining us, and it's a pleasure as always having you here on the program.